I need you to stop whatever you're doing. Put the coffee down, shut the other tabs, and stare at the screen. Check the price ticker on your phone. What does it read? Probably something around $71. Ladies and gentlemen, Asian guy here. Some of you know me as John AGI. If you're watching the COMEX spot price, the London Fix, or any of the big Western feeds, you're seeing a number parked right there in the low 70 seconds. And if you're a technical analyst, you're probably sketching lines across a chart, hunting for support, telling yourself the market is consolidating. You're telling yourself silver is holding the level. But I'm here to tell you the number on your screen is a lie. Not slightly wrong. Not delayed. A lie. A mirage. A ghost signal from a dead system that doesn't realize its heart has already stopped beating. Because right now, as I'm talking to you from the other side of the world, on the physical streets of Tokyo, the reality is radically different. We are getting confirmed. Verified reports from sources on the ground in Japan that retail silver bars are changing hands for 2,000 yen. Real. Physical metal you can hold in your hand. The kind people run to when currencies crack. Let's do the conversion together. At today's exchange rate, that's roughly $130 per ounce. Pause and let that land $130. Now, look back at your screen, $71. That's a $59 spread. An 83% premium. In modern financial history, we almost never see a gap this extreme between the spot price, which claims to represent the global value of the commodity, and the street price, what real people are actually paying to get metal in their possession. An 83% spread isn't a quirky inefficiency. It's a breakdown. It's the financial equivalent of a heart attack. A 2% spread is normal. That's the dealer's margin. 5% means hot demand. 10% means a squeeze. But 80% is a full-blown systemic fracture. It means the mechanism linking the paper market to the physical market is snapped. Now, I already hear the skeptics warming up in the comments. You're exaggerating. Japan has high taxes. There's consumption tax. Fabrication costs money. Shipping isn't free. Friction does not cost $59 an ounce. It doesn't cost $59 to stamp a bar. It doesn't cost $59 to ship metal across the Pacific. Even if you stack every tax, every insurance charge, every fabrication and minting fee on top of each other, you might get to $10. Maybe $15 if you're being generous. So where is the other $45 coming from? It's coming from panic. It's coming from scarcity. It's coming from the fact that the Japanese yen is imploding. And the Japanese people, some of the biggest savers on earth, are rushing for the exits. They're dumping currency and moving into hard assets at any price. They do not care that the COMEX says $71. They know that if they try to buy at $71, there is no metal available. The spot price is the price of a contract that can settle in cash. The street price is the price of survival. And right now, the price of survival is $130. This divergence is the clearest proof that arbitrage is dead. In a healthy market, banks' smart money act as the equalizers, stepping in to close gaps when price differences appear and restore balance through profit-driven trades. If silver is $71 in New York and $130 in Tokyo, a bank like JP Morgan or Goldman Sachs should be backing up the truck. They should be buying every ounce they can on the COMEX at $71, draining the New York vaults, chartering cargo planes, flying the metal to Japan, paying taxes, paying fabrication, and selling into Tokyo at $130 for massive profit. Even after costs, that's a risk-free $30, $40 per ounce on 1 million ounces. That's $30 million in free money. Banks don't leave $30 million on the table. They would do anything for that kind of return. So why aren't they doing it? Why is the gap sitting there day after day? Why isn't the trade closing? Because they can't. The plumbing is clogged. The logistical chain that connects a 10-pound industrial bar sitting in a New York vault to the retail market in Asia is broken. There isn't enough refining capacity to melt big bars into small ones fast enough to match demand. There aren't enough secure transport flights. And most importantly, the supply in New York is not as liquid as they pretend it is. If a bank tried to withdraw 10 million ounces from the COMEX today to ship to Japan, they would trigger a default. The exchange would stop them and force cash settlement. So the arbitrage trade is impossible. The banks are trapped in the paper world. Retail buyers are trapped in the physical world. And the bridge between them is burned down. This is what we call bifurcation, the world splitting into two separate realities. In reality A, the paper world, silver is cheap. It looks abundant. You can trade it with a click. The chart looks ugly. The technicals look bearish. And the price reads $71. In reality B, the physical world, silver is scarce. It's disappearing. You're waiting 6 weeks for delivery. You're paying massive premiums. The chart isn't a trend line anymore, it's a vertical spike. The price is $130. And you have to decide which reality you actually live in. If you're a paper trader, you live in reality A. You're watching your account balance and wondering why you aren't rich yet. If you're a stacker, you live in reality B. You're holding an asset that is effectively trading at double the so-called market rate in the real world. And history teaches us one thing: reality B always wins in the end. The paper market can suppress the price for a long time, but it cannot suppress a physical shortage forever. Eventually, the paper market runs out of metal to leverage, and the two prices snap back together. And they don't meet in the middle. The paper price always chases the physical price. New York rises to meet Tokyo. Tokyo does not fall to meet New York. But we have to be careful with this narrative. It's very easy to see an 80% anomaly and shout, "The banks are dead." It's easy to say JP Morgan is short at $71 while real silver is $130. They're insolvent. Collapse tomorrow. I see the thumbnails. I see the threads. Bankrupt, implosion, zero. And I'm here to tell you it's not that simple. Yes, the banks are hurting. Yes, they're bleeding. But if you think a bank with $1, $5 trillion in Tier 1 capital is going to collapse because of a few $1 billion of silver losses, you are underestimating the enemy. You're underestimating the armor they wear. To understand how this squeeze actually plays out, why it's going to be a slow, grinding war rather than an overnight victory party, we have to look at the balance sheets of the giants. We have to look at the death myth, because the banks are not dead. They're wounded. And a wounded animal is the most dangerous thing in the forest. Let's look at the math of their survival. If you open the latest Commitments of Traders report from the CFTC, the report that tracks who holds what on the COMEX, you will see a number that looks, at first glance, like a death sentence. The commercials, the polite label for bullion banks like JP Morgan, Citibank, and Bank of America are sitting on a net short position of roughly 4,000 contracts. Now do the multiplication. One contract is 5,000 ounces. 4,000 times 5,000 equals 200 million ounces of silver. That is the size of the bet. They are effectively wagering that the price goes down, or at least stays stable, on 200 million ounces of metal. And right now, the price is not staying stable. It's ripping. If silver moves from $71 to $100, a move of roughly $30, you multiply that $30 by 200 million ounces. The result is $6 billion in mark-to-market losses. In the real world, if a hedge fund lost $6 billion overnight, they'd be liquidated. Their furniture would be on the street. Their CEO would be hauled in front of Congress. It's catastrophic money. And that is why the internet is on fire with rumors. That's why you see tweets claiming Bank of America is insolvent or JP Morgan is trapped. Because the math says they're underwater. The math says every time silver ticks up $1, they bleed another $200 million in cold. Hard cash. But here's the uncomfortable truth, the end the Fed crowd doesn't want to hear. $6 billion is a rounding error for these people. You have to understand the scale of the monster. We're not talking about a small family office. We're talking about systemically important financial institutions. So, look at their armor. Tier 1 capital. Tier 1 capital is the core measure of a bank's strength equity, retained earnings, and the buffer designed to absorb shocks. JP Morgan alone carries a Tier 1 capital buffer of roughly $300 billion, the big 4U. As this, banks, combined, sit on total assets above $10 trillion. So compare the scale. On one side, a $6 billion silver loss. On the other, a $300 billion safety net. That silver hit is maybe 2% of the buffer. Does it hurt? Yes. Does it trash quarterly earnings? Absolutely. Shareholders scream. Bonuses shrink. Traders get fired. But does it bankrupt the institution? Does it force them to hand over the keys? No. It's like getting a flat tire. Annoying. Yes. Costs money. Yes. But it doesn't mean you abandon the car and walk forever. You've got a spare. You've got insurance. You've got a credit card. And the bullion banks have the ultimate credit card, the Federal Reserve. And there's another layer to this survival story that almost nobody talks about. It's the hedge. People look at the COMEX short position and assume it's a naked short, meaning they sold silver they don't have just to gamble. But banks aren't gamblers. They're bookies. And bookies balance the book. While they're short 200 million ounces on the COMEX, the visible market, they're likely long hundreds of millions of ounces in the OTC market. The over-the-counter market is the market the public can't see. Think about how a bank actually operates. A silver miner in Mexico digs up metal and wants to lock in a price to pay workers. So they call JP Morgan and say, I'll sell you 10 million ounces at $70. JP Morgan says, deal. Now JP Morgan is long 10 million ounces, either physical silver or a forward contract tied to it. But JP Morgan doesn't want to bet on direction. They want the fee. So what do? They go to the COMEX and short 10 million ounces. Now they're neutral. If the price rises, they lose money on the COMEX short, but they make money on the miner contract. The two positions offset. That 40,000 contract short position you see in the CFTC report could, to a significant extent, to be a hedge against real metal. They've already contracted from miners. So if the price rips to $100, yes, they lose $6 billion on the COMEX short, but the value of those miner contracts gains roughly $6 billion, net close to zero. Now, I'm not saying they're perfectly hedged. They play games. They take risks. They absolutely carry some naked exposure. There's likely a speculative slice of that short that's bleeding hard. Maybe they're unhedged on 50 million ounces. That's a $1. 5 billion hit. That stings. That's painful. That's why you see liquidity injections. That's why you see stress in funding markets. They need cash to meet margin calls on the short side while they wait for the long side to pay out. That's a liquidity crisis, not a solvency crisis, and the difference matters. A liquidity crisis means you're wealthy but cash tight right now. A solvency crisis means you're broke. The banks are dealing with a liquidity squeeze. Cash has to show up immediately to feed the COMEX margin machine. But they're not necessarily bankrupt. And this distinction is critical for strategy. If you convince yourself the banks will go bankrupt tomorrow, you make reckless bets. You buy short-dated calls. You load up on leverage, thinking, this is it, collapse next week. And then the banks do what they always do, deploy capital. Meet the margin, survive the day, and use their algorithms to slam the price back towards $70 for a few sessions just to shake you out. They have the staying power to fight a war of attrition. They can absorb pain longer than you can stay solvent if you're using leverage. This is a painful deleveraging, that's the right term. They're unwinding bad bets. They're eating losses. They're stepping back from the market. Why do you think silver went from $20 to $71 in the first place? Because the banks are easing off suppression. They clear's throat are realizing it's too expensive to keep fighting the trend. When silver was $20, they could smash it with ease. At Shaptazech Shi Unu, with shortage pressure building. Smashing the price cost billions in collateral. So they retreat. They let the price rise. But they do it in a controlled, managed way. They manage the retreat. They're not dying. They're repositioning. And don't forget the final safety net, the rules. If things truly get out of hand, if silver rips to $200 overnight and a $6 billion loss becomes a $60 billion loss, do you think the exchange will just let the banks fail? Do you think the government will let the financial system break over a shiny metal? No. They will change the rules. We've seen this movie before. In 1980, when the Hunt brothers cornered silver, the exchange flipped the market to liquidation only. You could sell, but you couldn't buy. They broke the Hunts to protect the system. In 2022, when nickel exploded on the LME, they simply canceled trades. They rewound the tape and said the trades never happened. If silver goes vertical to the point it threatens the solvency of JP Morgan, COMEX can declare force majeure. They can halt trading. They can force a cash settlement at a fixed price. They can say, okay, the price is $75. Everyone settles here. Market closed. That's why I keep saying don't play their game. If you hold a paper contract betting on collapse, they can rewrite the rules of the contract. If you hold physical metal, they can't rewrite physics. They can't cancel the bar in your safe. But as long as you're in their casino, the COMEX, the house always wins. Or at least the house never dies. So erase the banks go bankrupt tomorrow narrative. It's a fantasy. The banks survive. They limp away with a bloody nose and a smaller bonus pool. But they survive. And here's the twist. Their survival mechanism, the retreat, is exactly what clears the path for silver to rise. They're no longer the wall blocking the price. They become the speed bump. They step aside because the cost of manipulation has exceeded the benefit. And why has the cost gone up? Why is it suddenly so dangerous for them to stay short? Because of the physical variable? Because of the one thing they can't hedge, can't print, and can't regulate away. It's the supply shock. The banks can play paper games all day. But they can't play games when physical metal stops showing up at the port. And that is exactly what's happening today. The real threat to the suppression scheme isn't the bank balance sheet, it's the China wall. Today, January 19th, The new rules out of Beijing went live. And while everyone was busy watching bank stocks and premium spreads, the Chinese government quietly shut the gate. This is the structural break that rewrites the equation for the next decade. This is the pivot. This is the red dragon. This is the moment where the story flips from financial engineering to geopolitical reality. We've spent the last few minutes dissecting Western bank balance sheets, arguing over whether a $6 billion hit is fatal or merely painful. But while we were staring at the paper fire in New York, the real arsonist was striking a match in Beijing. Because today is January 19th. 2026. Look at the calendar. This isn't just another date, it's the opening chapter of a new era of resource nationalism. As of this morning, China's new export regulations around strategic dual-use metals are officially active law. And with a single signature, the largest producer and consumer of refined silver on Earth has effectively raised a wall around its borders. You need to understand what just happened. The media is calling it export licensing, using soft, soothing language. China isn't banning silver exports, they're just requiring permits for quality control. Don't be naive. Licensing is bureaucratic code for a soft ban. Under these new rules we've reviewed and broken down, the only players permitted to move silver out of China are the mega refiners, the massive state-aligned enterprises that answer directly to the central government. The hundreds of smaller private refiners, the scrap recyclers. To the trading houses that used to push excess metal into the global market, they've been cut off. They can't secure the approvals. They're now forced to sell into the domestic market. And what about the mega refiners? Do you think they're going to export on paper? They can. In practice, they won't because their mission has changed. For the last 20 years, the mandate was profit, refine silver, and sell it to whoever pays the most, whether that's a tech company in California or a bullion dealer in London. Today, the mandate is strategic security. Their job is to make sure China's solar industry, EV supply chain, and military-industrial complex get first claim on every ounce produced within the People's Republic. They will only export if there's a surplus. And here's the terrifying reality: there is no surplus. China is running a massive internal deficit in silver. They produce roughly 3,500 metric tons a year from their own mines. But their industrial machine, the beast that turns out most of the world's solar panels, consumes over 6,000 tons a year. Do the math: 3,500 minus 6,000. That's a deficit of 2,500 tons. In the past, they filled the gap by importing ore, refining it, and sometimes exporting finished bars to balance flows. But now, with solar demand exploding, especially the newer TOPCon and HJT panels that use 50% to 80% more silver per watt, their internal hunger isn't just strong, it's insatiable. They need every ounce they mine and every ounce they can import. From Beijing's perspective, exporting silver right now is basically an act of treason. It's selling the fuel of the future to the enemy. So the wall is real, not a concrete wall, a regulatory wall. Western buyers, bullion banks like JP Morgan, tech giants like Tesla, who used to rely on a steady stream of Chinese silver, are waking up to a dial tone. They're calling suppliers in Shanghai and hearing, "Sorry, we can't get the license approved. Sorry, the Ministry of Commerce flagged the shipment. Sorry, domestic demand absorbed the entire lot." And that creates a permanent structural deficit for the West. You have to understand how fragile the Western silver market actually is. The United States does not mine enough silver to meet its own needs. Europe doesn't either. We are deficit regions. We rely on imports Mexico, Peru, and historically China to keep the system supplied. Remove China, and you've kicked out one leg of a three-legged stool. The stool tips over. That means the West has to fight harder over what remains from Mexico and Peru. It means premiums in the West have to rise permanently to attract metal. This isn't a one-week squeeze. It's a rewiring of global flows. For decades, silver flowed east to west. Starting now, the river stops, and it may even reverse. China could start bidding aggressively for Mexican silver, competing directly with U.S. buyers. And this is where industrial panic shifts from a slow burn into a wildfire. We've talked about Samsung and Tesla before, but think about the second-tier companies, medical device manufacturers, 5G infrastructure builders, aerospace and defense contractors. They don't have Tesla's political leverage. They don't have the balance sheet of an Apple. They relied on the open spot market. They relied on being able to click a button and buy silver at the London fixed price plus 10. That world died today. Now they're staring at a market where the spot price is $71. But the China price is $110. and the Japan price is $130. They're watching global inventory get sucked into an Asian black hole. This creates a psychological shift called inventory hoarding. In supply chain theory, when a critical input becomes scarce, companies stop ordering just in time and start ordering just in case. They overorder. If they need 10000 ounces for February, they order 20000 just to be safe. Because having too much silver is a minor cost storage. Having no silver is a fatal cost factory shutdown. This behavior amplifies the shortage. It becomes self-fulfilling. The moment one firm starts hoarding, everyone else must hoard or be left with nothing. We're seeing the early signs already. Phantom demand is rising orders placed not for consumption, but for safety. And that phantom demand is hitting a market that just lost its biggest supplier. This is the real trigger for the squeeze. Banks can manipulate the paper price on the COMEX because it's a closed loop of digital contracts. But they can't manipulate the fact that a factory in Ohio needs physical silver to build a cruise missile guidance system, and that the silver is sitting in a vault in Shanghai that just locked its doors. A bank can't print a silver bar, and it can't force China to export. For the first time in history, Western financial elites are running headfirst into physical reality. They can print dollars to bail out shorts, but those dollars are useless if there's nothing to buy. What good is $1 billion when the seller says, "Not for sale"? And that creates a bifurcation in the industrial base. Companies with factories inside China, like Tesla's Shanghai Gigafactory, are insulated. They can access domestic metal, pay the local price, and keep running. Companies with factories in the U and Exportsea or Europe are in the kill zone. They're cut off from Chinese supply and forced to fight over a shrinking Western pool. That will push Western premiums up until they match the East. It has to. If silver is at 100 radio in Japan, why would a miner in Mexico sell to a U.S. refiner for $71? They won't. They'll ship it to Tokyo. Money goes where it's treated best. Commodities go where they're paid the most. Unless the COMEX price rises to meet Asian prices, COMEX will get drained ounce by ounce. The miners will bypass New York. The refiners will bypass London. They'll sell directly to the desperate buyers in the East. And that brings us right back to the banks. Remember, in part 2, we said they aren't dead because they have Tier 1 capital. That's true. They have money. But money can't solve a logistical blockade. JP Morgan can write a $5 billion check to cover a short position. But if a client stands for delivery, if the client says, "I want the metal, not the cash," JP Morgan has a problem, because JP Morgan can't get a license to export silver from China either. The armor of capital protects them from insolvency. But it doesn't protect them from delivery default. It doesn't protect them from the humiliation of telling a client, "We don't have it." And that's the weak point. That's the thermal exhaust port on the Death Star inventory. The banks can handle a price squeeze. They can't handle an inventory squeeze. If the COMEX vaults run dry, if the registered category hits 0, the game stops. The illusion of infinite liquidity breaks. And thanks to the China wall, the replenishment rate for those vaults just dropped toward 0. No new metal is coming from the East to save them. They're on their own. They're fighting a war with whatever ammo is left in the bunker. And the supply lines have been cut, so how much ammo do they actually have? How close are we to that 0 moment? You hear numbers tossed around 100 million ounces, 50 million ounces, but the only number that matters is the metal available for immediate delivery registered. Because once you peel back the layers of the COMEX report, you realize most of the silver in those vaults doesn't belong to the banks. It belongs to investors who aren't selling. The amount of liquid silver available to stop panic is terrifyingly small. It isn't an ocean. It's a puddle and the sun is beating down. So let's look at the thin ice. Let's look at the specific inventory data that proves COMEX is running on fumes. Because once you see how little is actually left, you'll understand why premiums are 80%. You'll understand why the market is terrified. Let's open the vault. And when we finally pry open the heavy steel doors of the COMEX depositories in New York, what we find isn't a fortress of infinite wealth. It isn't a mountain of bars stacked to the ceiling, ready to flood the market and crush speculators. What we find is a hollow echo. We find a crime scene where the evidence has been systematically removed bar by bar, truckload by truckload, until only the dust remains. We need to talk about the number 38 million. According to the latest Daily Warehouse stock report, released quietly while the media was distracted by New Year celebrations, the total amount of registered silver in the COMEX system has fallen to 382,000,000 ounces. To the average person, 38 million ounces. Sounds like a lot. It sounds like a dragon's hoard. but you have to view it through the lens of the global market. The world consumes roughly 1 billion ounces of silver every year. That averages out to about 3 million ounces per day. So do the math. 38 million divided by 3 million per day, 12 days. That's it. The global benchmark for the price of silver, the exchange that claims to set value for the entire planet, is sitting on less than 2 weeks of global supply. If mines stopped producing tomorrow, or transport stopped moving, COMEX would be bone dry in 12 days. This is not a buffer. This is not a reserve. This is thin ice, and the ice is cracking under the weight of the demand we just talked about. But the situation is actually worse than the headline number suggests, because the banks play a shell game with inventory data to make it look healthier than it is. They'll point to total inventory, usually around 270 million ounces, and say, look, there's plenty of silver. Panic is unnecessary. But that's lying by omission, because inside that total are two categories, eligible and registered. Registered is the metal actually available for delivery. It has a warrant attached. It's ready to fulfill a contract. That's the 38 million. Eligible is the rest, roughly 230 million ounces. But eligible only means it meets purity specs and is sitting in the vault. It does not mean it's for sale. That metal belongs to private investors, family offices, and people who pay storage fees to keep it there. The banks can't touch it. They can't deliver it to cover shorts unless the owner chooses to sell. And ask yourself, if you own silver in a COMEX vault, you see Japan paying $130, and the bank wants to pay you $71, are you going to sell? No. You're going to hold, or you're going to withdraw it. So the eligible pile is effectively frozen. It's dead weight. The only real liquidity in the system is that tiny. A shrinking stack of 38 million ounces in the registered category. And this is where the market's gravity kicks in. We call it Gresham's Law. You probably heard it in econ. 101 bad money drives out good. In the silver market, it translates to this fake paper prices drive out real physical metal. When a commodity is priced artificially low, subsidized by paper manipulation, the market drains the physical supply until there's nothing left. Think about it. COMEX is basically a store selling silver for $71. While the rest of the world, Japan, China, the UAE values that same silver at $100 plus. What happens if one store sells iPhones for $500 while they're $1,000 everywhere else? You get a run on the store. Smart money arbitrageurs, industrial buyers. Sovereign wealth funds will stand for delivery on COMEX, not because they want to crash the system, but because it's the cheapest place on earth to source metal. They're looting the vault legally. They're using the suppression scheme itself to strip mine the exchange. That's why the inventory is collapsing. It isn't an accident. It's the direct mathematical consequence of price suppression. The banks became victims of their own success. They pushed the price down so effectively they turned silver into the most undervalued asset on the planet, and now the world is backing up the truck to take it away. Every time they smash the price down to $71 to protect shorts, they ring the dinner bell for physical buyers. They're basically yelling flash sale, and the buyers are responding. Withdrawals accelerate. Loadout notices, requests to physically remove metal from the vault system, are hitting levels we haven't seen since 2021. But this time, the starting base is much lower. And here's the terrifying part for the shorts. The refill mechanism is broken. In the past, when registered stocks got this low, metal would flow in from London or China to rebuild stocks. Eligible holders would be tempted to sell. Miners would ship extra bars. But today, we've established that China is closed. No metal is coming from the east. And eligible holders, they're looking at inflation data. They're hearing war drums. They're seeing premiums. They're not selling at $71. They're waiting for triple digits. So the refill isn't happening. The drain is one way. It's a bathtub with the drain wide open and the faucet turned off. It is a mathematical certainty that the water level eventually hits zero. So, what happens when it hits zero? What happens when registered drops from 38 million to 10 million? And then to zero? Does the world end? Does COMEX explode? No. The system protects itself. This is where the paper game shows its final trick. The exchange will likely declare they are suspending physical delivery. They'll cite logistical bottlenecks or market irregularities. They'll invoke force majeure. And they'll tell the people waiting for metal, we're very sorry. We can't give you the silver bars. But good news, we'll give you the cash equivalent. They will settle at $71. They will force you to take the paper currency you were trying to escape. That is the moment of default. They won't call it a default on CNN. They'll call it a settlement procedure. But to anyone who understands what money is, it's a default. If you bought a car and the dealership took your money and then said, sorry, no car, here's your money back, you'd be furious. But at least you still have the cash. In the silver market, getting the cash back is a disaster. Because while you're holding your $71 cash settlement, the real price of silver, the price you must pay to actually get metal, could be gapping to $150. You get priced out. You get trapped holding depreciating fiat while the asset leaves the solar system. That's why inventory data matters so much. 38 million ounces is the countdown clock. Every million ounces that leaves brings us one day closer to the cash settlement moment. And smart money knows it. That's why the drain accelerates. It becomes musical chairs. Thousands of paper contracts, but only 38 million ounces of deliverable metal. When the music stops, and it's stopping right now, only the people sitting on physical bars win. Everyone else gets a check that can't buy anything. And don't underestimate how fast this can unravel. In a panic, inventory doesn't drain linearly, it drains exponentially. The moment the headline hits COMEX registered falls below 20 million, the psychological dam breaks. Hedge funds that normally trade paper will say, "Get the metal out now." Industrial users will say, "Secure inventory regardless of price." We could see the remaining 38 million vanish in a week. We saw it with nickel. We saw it with palladium. When the floor drops, it drops all at once. So we have a banking system that's bleeding liquidity, but still armored with capital. We have a Chinese supply shock that's choking off new metal. And we have a COMEX vault running on fumes less than 2 weeks of supply in registered. That's the perfect storm for a structural repricing. But it's not going to be a straight line up. The banks aren't going to roll over and die. They're going to fight. They're going to use every weapon they have to make the path to $100 as painful, volatile, and confusing as possible. They're going to try to shake you out before the payoff. So how will they do it? What does the roadmap for 2026 look like? How do we go from $71 to $100 without getting liquidated? Along the way, we have to understand the tactics of the managed retreat. We have to understand the war of attrition because the next 12 months won't be a party. There'll be a grind. The data is overwhelmingly bullish. If you fed this into a computer simulation, silver would gap to $100 tomorrow morning. But markets aren't computer simulations. They're battlefields. And the enemy you're dealing with, the consortium of bullion banks and the exchange machinery around them, hasn't surrendered yet. They're retreating. Yes, but a retreating army plants landmines. And I need to shatter a dangerous illusion right now. There's a fantasy floating around social media that because inventory is low and the shorts are trapped, we're going to see a vertical explosion. Clears throat. People think they'll wake up on Monday and see silver at $100. They think it'll be a straight line up a single God candle that fixes their financial lives in 24 hours. That's not how this plays out. The path to triple digits in 2026 won't be a rocket launch. It will be a grind. A dirty, volatile, exhausting war of attrition designed to rip the position out of your hands before the finish line. You have to understand the difference between direction and control. The banks have lost control of the direction. The China shock and the inventory drain mean price must rise. The physics of the market demand it. But the banks still have control over the speed. They still run the casino. They still set margin requirements. They still control the algorithms. And they're going to use that control to make sure the climb from $71 to $100 takes as long as possible and inflicts maximum pain on leveraged speculators along the way. How will they do it? What weapons do they have left? Their first weapon is volatility. Expect price action to turn violent. We'll see days where silver rallies $5 in the morning, only to crash $7 in the afternoon. Why? Because the banks know retail traders love leverage. They know you're buying call options. They know you're trading futures with 0-to-1 margin. So they'll engineer sudden, terrifying drops, flash crashes designed to trip your stops. Their first weapon is volatility. Expect price action to turn violent. We'll see days where silver rallies $5 in the morning, only to crash $7 in the afternoon. Why? Because the banks know retail traders love leverage. They'll smash silver from $75 down to $68 in 10 minutes. Wipe out the longs. Then let it float back up to $75. That's stop running. That's how they manufacture liquidity. They force you to puke your position at a loss and then they buy it back cheaper to cover. If you're holding paper contracts, you're standing in the middle of a highway trying to pick up pennies. You will get run over. Their second weapon, the nuclear option, is margin hikes. We've already seen it begin. COMEX has quietly raised margin requirements twice in the last month. They'll do it again. When silver hits $80, they'll double margins. When it hits $90, they might triple them. Why? They'll claim it's for market stability. The real reason is to price out the little guy. If it costs $10,000 to hold a contract, many retail traders can manage it. If they jack it to $50,000 overnight, retail gets margin called. They don't have the cash. They're forced to sell. Who can meet the new requirement? The banks. By hiking margins, they force weak hands to fold and leave only institutions at the table. They effectively gentrify the bull market. They clear the room so they can enjoy the ride up without you. This is why the bank death myth is so dangerous. If you bet on them dying tomorrow, you lose. They have the capital to survive the margin hikes they impose. You don't. So what does the roadmap actually look like? I think we're entering a stair-step repricing. We won't go straight to $100. We grind toward $80, then chop sideways for 3 months. It'll be boring, frustrating. The headlines will say the rally is over. That boredom is the point. It's designed to make you lose interest. They want you to sell silver and go chase Nvidia or Bitcoin. Then once the weak hands are gone, we gap to $90 overnight. Then another crash. Then another grind. It's a mechanism of exhaustion. They want to exhaust buyers psychologically. They want to make holding silver feel like a burden, not a joy. But while the paper price plays these games, the physical reality keeps tightening like a noose. Remember the 38 million ounces in the vault while price chops sideways? That number keeps ticking down. 35 million. 30 million. 25 million. The divergence between the paper game, volatility, and the physical game, depletion, widens and widens until the rubber band snaps. The target is $100. I have no doubt we see triple digits in 2026. The structural deficit created by the China ban is roughly 200 million ounces per year. Investment demand adds another 100 million. Mine supply is flat or declining. The math is undeniable. We need a price that destroys demand. We need a price high enough to make people recycle their grandmother's silverware. $71 doesn't do that. $80 doesn't do that. $150 might start to do that. So price has to go there, but it goes on the bank's timeline, not yours. Right now, they're managing a controlled demolition of their short position. They cover shorts on dips. They slowly flip their book from net short to neutral. And once they're neutral, once JP Morgan and friends have cleaned those toxic shorts off the balance sheet, then, and only then, do they let the price run free? In fact, once they're positioned long, they become the biggest bulls in the room. They'll use media mouthpieces to pump it and raise targets to $200. They'll ride the wave up the same way they rode it down. Because banks don't care about low prices or high prices. They care about being on the winning side. Right now, they're trapped on the losing side. The volatility of 2026 is simply the sound of them switching teams. So how do you survive the transition? How do you hold on when price drops $10 in an hour? How do you keep conviction when the news says it's over? You stop playing their game. You stop treating the paper price as a signal of value and start treating it as a signal of opportunity. You adopt the mindset of an industrial buyer, not a speculator. Samsung doesn't sell its silver inventory because price dropped $5. They hold it because they need it. You hold because you understand the currency is weakening. Supply is vanishing. And the repricing is inevitable. You understand that the physical reality doesn't care about headlines, algorithms, or daily volatility. It only cares about availability. And as long as that reality keeps tightening, the long-term outcome is already decided, regardless of how violent or exhausting the path becomes. We're watching the end of a 40-year suppression cycle. These cycles don't end quietly. They end with noise, confusion, and violence. The banks are going to kick and scream. They're going to bend rules. They're going to change margins, but they can't print silver. And as long as that fundamental truth holds, as long as the vault is draining, the destination is locked. The only variable is the path. So tighten your seatbelt. Don't use leverage. Don't try to outsmart the algorithm. Just hold the asset, because when the dust settles and the banks finish switching sides, the price is going to a place where the current charts don't even have numbers. That brings us to the final piece of the puzzle strategy. We've talked about what they're doing. Now we need to talk about what you should be doing. We talked about the Japan trap, the danger of paying 80% premiums. But if you can't buy in Japan and you can't trust paper in New York, where's the sweet spot? How do you exploit this broken market without getting burned? There's a narrow window open right now, a way to use COMEX manipulation to your advantage before the door closes. Let's wrap this up with the battle plan. Let's start with the Japan scenario, because it's the biggest mistake I see people making. When you see headlines about Japanese buyers paying $130 an ounce, your instinct is panic. Your instinct is, if they're paying $130, I need to buy now at any price before it goes to $200. You have to fight that instinct. Paying an 80% premium over global spot is not investing. It's financial suicide. When you pay $130 while the rest of the world values it at $71, you're immediately underwater. You're handing nearly half your capital to the dealer, the refiner, and the taxman. That premium isn't value. It's fear. People in Tokyo aren't buying because they're savvy. They're buying because they're terrified their currency is evaporating. They're price insensitive. You're not price insensitive. You're a strategist. Don't chase panic. Let the mob pay the panic tax. You play a smarter game. And the opportunity, the ironic gift the manipulators accidentally handed you, sits inside the suppression itself. Think about what the banks are doing. They're spending billions of their own capital to artificially pin the paper price down at $71. They're doing it to save themselves, defend their short exposure, and to prevent a chaotic repricing. But their desperation becomes your discount. By forcing the paper spot price down, they are effectively subsidizing your ability to buy real metal. Yes, you still pay a premium. Maybe it's $5 or $8 over spot for a generic bar. But run the numbers. $71 plus $8 equals $79. Now compare that to Japan at $130. Same asset, same atomic element, yet you're buying it with a $50 discount simply because you're operating inside a market where the manipulation is still alive. That's the trade of the decade. You are, in effect, arbitraging the system's own distortion. They're holding the price down to conceal the truth. You're using that suppressed price to accumulate the truth. Every ounce you acquire at $79 is value extracted from a structure trying to mislead you. So the strategy isn't to sit around and wait for manipulation to end. The strategy is to exploit it while it still works, because once the COMEX breaks, once registered inventory hits zero and force majeure gets declared, the spot price, as you know, it won't matter. The discount window slams shut, and suddenly New York prices have to converge with Tokyo. You want to be the buyer who accumulated at $79, not the person standing in line, later paying $130. But, and this is the most important warning, you're going to hear this strategy only works if you buy physical silver. I can't say it any more clearly. Don't buy paper. Don't buy SLV. Don't buy unhedged mining equities. Don't buy futures contracts. And for the love of God, don't park your money in an unallocated pool account at a bullion bank. Here's why. Because the banks will try to lure you into the trap. They'll say, physical is expensive. Premiums are high. Shipping is annoying. Just buy our unallocated silver instead, pure spot price at $71, and we'll store it for free. Sounds attractive, right? It's a setup. Unallocated means you don't own specific bars. You own a claim against the bank's general inventory. You are an unsecured creditor. If the bank goes insolvent, or if they simply run out of metal, you don't receive silver, you get shoved into a line with everyone else, fighting over leftovers. And remember what we already established, the vaults are draining. Inventory is at historic lows. If you hold an unallocated account right now, you're essentially lending money to a bank that is short the very asset you think you own. When the squeeze bites, they'll settle you in cash. They'll say, here's your $71. Have a nice day. Meanwhile, real physical silver, the bar you actually wanted, will be trading at triple digits. You'll have profit in fiat terms, but you'll lose the purchasing power. You'll miss the entire point of the trade. The only way to win this war is possession. If you don't hold it, you don't own it. It's a cliche for a reason. When you hold the physical bar in your own safe, you remove counterparty risk completely. JP Morgan can go bankrupt. COMEX can shut down. China can ban exports. It doesn't matter. The bar in your hand is still silver. It's immune to their rules. It's immune to their failures. That's why we pay the premium. The premium is the price of freedom from the banking system. So here is your battle plan for the next 12 months. Step 1. Ignore the volatility. The banks will smash the paper price. They will create flash crashes. They will try to scare you out. Don't look at spot as a measure of your wealth. Look at the number of ounces you own. Ounces are the scorecard. That is how you track progress in this war, not daily price noise. Step 2, buy the dips in the physical market. When they smash spot to $68, don't panic sell. Go to your dealer and buy more. Use their manipulation to lower your cost basis. This is not trading. This is accumulation. You are exploiting their defense mechanism to build position while the window remains open. Step 3, watch registered inventory like a hawk. That is the real countdown clock. When you see it drop below 30 million ounces, you know the end game is on. That's the signal to stop buying and start holding tight. From that point forward, availability matters more than price, and possession becomes everything. We are watching a slow-motion train wreck of the legacy financial system. The banks are hurt, make no mistake. They're bleeding billions. Vaults are draining. Reputation is cracking. They're fighting a retreating war. trying to manage the collapse of their own suppression scheme. They're powerful. Yes. They have capital. Yes. But they're on the wrong side of history. You can't suppress a strategic metal forever when the world is running out of it. Physics eventually crushes finance. The squeeze is real. It's not a conspiracy theory. It's math driven by the structural deficit we just laid out. China has locked the gate. Industry is hoarding. COMEX is running on fumes. The destination is $100 and beyond. The only question is whether you'll be holding a bag of paper promises or the heavy, shiny reality of true wealth. The analysis is done. The strategy is set. The window is open. But it's closing fast. Don't buy the hype. Buy the metal. I'll see you on the other side. Like, subscribe, and share.